Have you ever wondered why two people, despite saving the same amount of money each month and having the same income, end up in very different financial positions? It's not about how much they save, but about one crucial change that occurs inside their investment accounts. This change is something most people either miss or misunderstand, and it completely alters their financial journey. At some point in every investor's life, something quietly flips. Early on, you're doing all the work. Every dollar you put into your account matters, and you're the engine driving the growth. But after a while, things start to shift. The money you've invested begins to work for you. Then, it starts to work harder than you are. Your monthly contributions, the money you worked for, begin to look insignificant compared to the returns your portfolio is generating on its own. That shift is what we'll talk about today. Many people spend years saving, but never ask when that shift happens. They focus on the contribution. How much should I put away? What percentage of my income? Should I cut my expenses to save more? These are important questions, but the one question that almost no one asks is, when does the money I've already invested start working harder than I am? When does the growth in my portfolio start helping me, instead of just waiting for me to add more? I'm Matt, and on this channel, I break down personal finance in simple terms so you can make smarter decisions with your money. If that sounds useful, subscribe. I post every week. Let's start by discussing the wrong question. If you've ever read a personal finance article, watched a YouTube video, or had a conversation about money, the central question is almost always the same. How much should you be contributing? Should you be putting in 10% of your income? 15%? Should you max out your retirement account first? These are all reasonable questions, but they share a blind spot. They focus only on your contribution. And while that matters at the beginning, it is not enough to keep you on track for the long term. Here's a simple way to think about it. Imagine two people, both starting from scratch. Both put away $400 a month. After 5 years, their balances are close to each other. After 10 years, they're still relatively close. But then, something starts to change. After 15 or 20 years, one person who kept saving consistently is watching their portfolio grow by tens of thousands of dollars in a single year. Not from their paycheck, but from the returns on the money they already invested. Meanwhile, their $400 monthly contribution looks small compared to the growth of their account. That's not by accident, it's the shift we're talking about. Let's break down the two forces that are always at work inside your investment account. The first force is you, the money you earn, save, and contribute each month. This is active. It requires effort. It depends on you showing up, keeping your income going, and managing your spending every month. The second force is growth. This is the return that your existing portfolio generates on its own. It's passive. It doesn't require anything from you. It doesn't care if you missed a few paychecks. It just keeps building. And as your portfolio gets bigger, the growth becomes more powerful. At first, the contribution force dominates. You're doing most of the heavy lifting. The portfolio is small, so the growth is small. But over time, things start to change. Each dollar of growth gets added to your base. And next year, that bigger base generates even more growth. Eventually, the gap between these two forces closes and then flips. The growth you're generating on your portfolio surpasses the contributions you're making from your paycheck. Let's put numbers on this. If you're contributing $500 a month, that's $6,000 a year. Let's assume your portfolio grows by 7% per year. How large does your portfolio need to be before the growth it generates equals what you're putting in? The answer is around $85,000. Once your portfolio reaches that size, the returns it generates in a year equal the amount you're contributing. After this point, growth takes over. At $170,000, the growth is doing twice the work of your contributions. At $250,000, it's doing more than 3 times the work. This is when the math changes, and you start seeing how the process works. But here's the interesting part, the crossover point. The moment when your portfolio starts generating more growth than your contributions isn't something you actively work toward. It's something you either protect or accidentally destroy. The most dangerous time for any investor isn't before the crossover. It's right when it's beginning to happen. Let's talk about why most people don't even notice this shift happening until it's too late. The pattern in investor behavior shows us something surprising. When the market drops, who actually sells? We often think that beginners or new investors are the ones who panic and sell during downturns. But research shows that people with portfolios between $100,000 and $250,000, not beginners, are the ones most likely to sell at the worst possible time. Why? Because they're right at the crossover point, and that's psychologically uncomfortable. Think about it. If you have $10,000 invested and the market drops 20%, you lose $2,000. It's painful, but it's not a catastrophe. You've been through ups and downs before. But if you have $150,000 invested and the market drops 20%, you're looking at a $30,000 loss. That's a huge blow to your account, and your brain registers it as a disaster. Even though the math is still the same, this is when panic sets in. People who are just about to cross over see a large drop in their portfolios and think they need to sell before things get worse. And when the market recovers, they miss out on the gains. This is the behavioral trap. It's not that people are irrational, but when a large portfolio loses a large percentage, it feels like more of a disaster. The decision to sell at that moment is one most people regret. They exit the market right when things are about to turn around. The lesson here is that the crossover point is a psychological hurdle. The key is not to sell during those rough stretches. The decision to sell may be emotionally driven, but it's almost always a bad one. Now, let's talk about what happens after you've crossed over. Your portfolio is now generating more growth than you're contributing. Most people think that after this point, the job is done. They think they can just keep doing what they've been doing, contributing as usual, and that's all it takes. But there's a subtle shift that most people overlook. After the crossover, your biggest job is protection, not addition. Your job is no longer to contribute more money. It's to protect the growth that's already happening. Data from Fidelity, one of the largest investment firms in the world, shows that the best performing accounts aren't the ones where people made constant adjustments based on market conditions. The best accounts belong to people who either forgot about their investments or were too busy to touch them. They didn't do anything special. They just did nothing. And doing nothing outperformed active management by a significant margin. Once you've crossed over, your focus should shift from adding more to your account to protecting what you've built. This is when the biggest mistakes happen: selling during a downturn, pulling money out for a great opportunity, trying to time the market. These are all mistakes that can derail your growth. In the 2000 dot-com crash, many people made the mistake of selling at the wrong time, only to watch the market recover and exceed its previous highs. The key to protecting your portfolio after crossing over is staying the course. Don't act based on short-term fears. If you're too quick to make changes, you might miss out on the recovery that follows the downturn. The goal is to stay consistent, not to react to every dip. Trust the math and let the portfolio continue to grow on its own. To make this concrete, let's break it down with a simple formula. Take your monthly contribution and multiply it by 12. That gives you your annual contribution. Next, take your current portfolio balance and estimate the growth from last year, or use a standard 7% growth rate. If your annual growth is less than your annual contribution, you're still in the phase where you're doing most of the work. If your annual growth is roughly the same as your contributions, you're in the crossover zone. If your growth is greater than your contribution, you've crossed over. Here's an example. If you're contributing $500 a month, that's $6,000 a year. If your portfolio is worth $70,000, 7% growth gives you $4,900. Your contributions are still larger than your growth. But when your portfolio hits $90,000, 7% growth equals $6,300, which is more than your $6,000 contribution. At this point, growth has taken over. This is the moment when the real work begins. If you're below the crossover, the most important thing you can do is contribute more, either by contributing more money or contributing more consistently. But once you've crossed over, your focus should be on protection. Be cautious about taking money out of the portfolio or making unnecessary adjustments. Trust the process and let the portfolio grow. Remember, your contribution phase and your protection phase are two different stages. Before the crossover, the job is to add more. After the crossover, the job is to stay consistent and protect what you've built. Don't make the mistake of thinking that once you cross over, you're done. The job just changes. In conclusion, the key to building wealth through investing isn't just about how much you contribute. but about understanding the shift that happens when your portfolio starts generating more growth than you're contributing. Once you cross over, the real job is to protect what you've built and let the portfolio continue to grow. It's a subtle shift, but one that will make all the difference in the long run.